Hi, my name is Troy Emory, and we're going to talk today about the new tax changes in 2018. I've been in business now for 11 years, and we're going to get into the new tax changes that everyone's talking about these days.
Exemption. So let's say a person is, I don't know, a single mom, two kids, and they have now three exemptions. So you're saying, and that with this new tax law to bring home more money, can she increase her exemptions, or you're saying everything stays the same, or all of the dependents should always be based on the number of dependents in the household?
It's based on a number of dependents
Period.
in the household.
Okay.
Right.
And so you're not really looking, because I know a lot of people use, the exemptions to bring home more money. And they're
Right.
looking at, okay, I have a home, I have an interest deduction, I've got, property tax deduction,
Right.
I've got my unreimbursed expenses for my job, I've got a side business. So with all those things, I should be able to bring home more money,
Mm-hmm.
and manage my daily affairs,
Yeah.
uh, better. So are you saying those types of things that people are doing with the side businesses, all that is not as important anymore with this new tax law?
No, no, because you're still going to have to claim those dependents in order to get the $2,000.
Okay.
It's just that other things are really helping you out. The higher standard deduction, right? The lower tax rates are making up for a lot of the things that you can't do anymore, right? But you did touch on something that maybe I should go right into. Uh, the uh, the uh, the job related expenses,
Mm-hmm.
that's gone.
Okay.
That's gone.
Yeah,
So
that's good.
if people are relying on that, and a lot of people do,
Yeah,
they're going to be shocked.
especially those in uniform.
Yeah.
So a lot of my clients with uniform officers, et cetera, and even the list goes on.
Yeah.
All those are gone.
Well, I
Those
mean,
deductions are gone, right?
I mean, I'm just going to be frank. Um, some people have legitimate uh, job-related expenses, and some people have not so legitimate job-related expenses,
Right,
and that's all I'm going to say.
right.
Well, put it this way: it appears that they don't have legitimate job-related expenses, right? So if they're going to rely on that, that's going to be gone. But hopefully the higher standard deduction is going to help them out somehow, some way. But in most cases, if people are inflating those expenses, it's not going to really help them out.
Along with, I guess, the charitable donations.
Now, charitable donations are good. Charitable donations are good. Now you can even donate up to 60% of your adjusted gross income now. So those are good. I mean, some of the things, some of the good things that they left in the code was to encourage people to give more. And again, I mean, to be honest with you, that's a wealthy play. Wealthy people, they tend to give more money. They just do. I mean, there are people who make lower incomes that give a lot too. They give to churches and so forth. I've seen some really, really high donations to churches, and I'm telling you, they're legitimate donations. Makes me want to be a preacher, but um, I have seen it, and they are legitimate. You get the notice from the church, and you see some people making 20, 30, 40. What's the highest you've seen? $50,000. I mean, they're making a lot of money, but that stuff that stays in the code.
Okay.
That goes untouched.
So it's standardized 24, hypothetically, and then you still get the charitable deduction along with
If you're over the 24, so you have to reach that
Oh, okay,
$24,000
okay, okay.
threshold
Gotcha.
in order to itemize,
Right, okay.
right?
So that Schedule A changes a little bit.
Absolutely,
Okay,
absolutely, much smaller,
okay.
much smaller. Trying to think of. Moving expenses gone. Again, that was an area you saw a lot. They saw a lot of abuse.
Yeah, no question.
You know, another thing that really weighs on a lot of these changes is the fact of the matter is the IRS has cut its staff tremendously. They really have. And for you to be audited, you did something really wrong on your return to be audited, really. Because you know these IRS examiners, I'm not, again, I'm not on the IRS's side, but I feel for them because their caseload is so big now because they're cutting people, and then you got somebody who's doing now the job of 3 and 4 people. That's one thing that we do. We negotiate taxes, and I'm going to tell you the way these IRS examiners, these not examiners, but the revenue officers, you might hear from them today. It might be 6 months before you hear from them again because their caseload is so big. It's huge. So, in simplifying the tax code, a lot of that is trying to make up for all the budget cuts. I expect a lot less people are going to be audited now. A lot. I mean, if you think about it, you're going to have less things to audit. You can only you can only deduct mortgage interest on the acquisition debt up to $750,000 of the price of the home when you bought it. Well, the mortgage on the house when you bought it, right? So you know what that means? I'll get to your question in a second. What that means is on your 1098A, I'm sorry, your 1098, they're going to have the mortgage interest, and they're going to put on that 1098 what you originally financed. So how are you going to get around that? They put it right on the form what you originally took the mortgage out for, right? So you're not going to be able to get around that anymore. Some people might say, "Hey, look, I had 3 mortgages. Put all 3 of them on the Schedule A." There was no way to check it, but now they're checking. So you're not going to be able to get around that now. Yes, ma'am. I'm sorry. Oh, it'll come to you. It'll come to you.
I thought that for the new 2018 mortgage interest, I heard something about mortgage grandfathered in.
Yeah. There is a grandfather provision. There is a grandfather provision. But now, if you got those home equity loans, it does not include those that's not included. So most people, if you think about what's happened since, say, early 2000s, a lot of people refinance if they still got that same house, right? A lot of people, when the mortgage rates were low, they kept refinancing. So that stuff's going to be taken away now. The refinance. You can only for yeah, this point going forward. Correct. That's going to be taken away now because remember that was one of the incentives for actually refinancing your house, right? You get the higher interest deduction. So that's going to go away now. The home equity loans, that's going to go away now. You pull out additional cash, thinking that you're going to get the interest deduction. Why I'm talking about this? So look, if you are going to go pull some cash out of your house, if you are going to do that, be prudent about it, right? If you're really trying to get that deduction. Now, it does not stop you from taking that money and investing in some trade or business. You can deduct that interest. So if you go and you refinance to go buy a rental property, you go refinance and go start a business, nothing stops you from deducting that interest. So it's going to force you to be more prudent when you actually go and refinance these homes. Some people are doing so bad that I think that's the only thing they can do is refinance the house just to take care of some debt or whatever. I'm not talking about those type of people. I'm just talking about an individual who wants to refinance thinking they're going to get that additional mortgage. Be prudent about it. Invest the money in a trade or a business now. Rental property, business, or whatever.
So Schedule E interest, that's staying? So
That stays.
that's staying in
That stays.
Okay, so $1 million mortgage on investment property, no
That stays. You are right. You are right. But again, if you have to refinance, you know, you're going to have to weigh. Okay, do I want to do it on my personal residence, or do I want to do it on? I want to get the biggest bang for my buck. I want to refinance on the home on the home that I live in. If I own rental property, and I'm going to think about dumping that into the rental property, right? So, you know, if I just keep it and pay off some bills that I have and think I'm going to get the deductions, you're not going to be able to get those deductions.
Would you create some from LLC or something and go over to the investment property?
You're going to have to prove it, yeah. You're going to have to prove it. You're going to have to do some type of repairs or something, acquisition or something. You're going to have to prove it. If you guys want to reach me, you can reach me at 301-474-1040, or you can email me at troy_emery@tdecpa.com, or go out to our website, www.tdecpa.com.